Hi, good morning. I just wanted you to know how I'm going to be thinking about NFP, which is the only thing that really matters next week. We have a lot of noise coming from other data, but the NFP really is going to be the one that's going to be the signal. So I'm looking at gaming various scenario. And the most important one to know is that 150 to 175 is basically the range of expectations. Now, the last one was the shocker, but every single piece of data since the last one has basically been not confirming that outlier. So what are we going to see the curve do in the various scenarios that I've outlined here? Anything soft really is 120,000 and lower, and of course the lower it is, the softer the number is. But it really would be a shock to see a soft number. Why? Because every single piece of data that's come out since that number, and that number could very easily be revised upwards, and it could very easily have been caused by some weather-related causes. And there's a lot of speculation as to that. So if we now return to the 150, 175, or God forbid 175 and higher, which would confirm the data that we've had since the last NFP, then we can game these different scenarios and give them different probabilities of outcome. The other thing that's important to bear in mind is that as soon as the NFP comes out, we will be speculating as to what is in the dot plots that arrive 10 days later. So these are the last projections we have from the Fed, and we have the unemployment rate at 4% for 2024, 4.2% for 2025. Naturally, we're at 4.3, but if the number is in line, we will be not revising upwards this number very much from where we are, i.e. the market will be looking for a steadier unemployment rate rather than one which is accelerating away. So that is important to know. And the other thing that's important is these dot plots and to see how far they will go. I am pretty convinced that whatever the number, i.e. even if it's hot, i.e. even it's 175, 180, 190, we will not see a very big deviation from 325 basis point cuts in 2024, i.e. a cut at every meeting. Cut in September, cut in November, cut in December, which basically means that these dot plots should come down below this, the lowest that we have here. They should come down to this area. The important one will be 2025. I think these outliers will disappear, and we should get something like a further 4 cuts in 2025, which should take us to around the 375 area as a mean. I don't think the longer term dot plots are going to change very much. They'll probably bunch up, but I don't think that for the 2026 you will see them much below 3% where they are now. I think this just bunches up, and these longer term ones bunch up as well to somewhere between 2.5 and 3%. So that should basically be the outcome of the dot plots, even if the number is slightly hot. The real question is what happens if the number is lower. That is going to be the real question. And let's have a look at what the predictions would be in the sofas. So what I've done here is I've put in 350 basis point cuts in 2024. Now, why have I done that? I think it's likely that if the number is soft, i.e., 120 and lower, the market goes for at least a 50 to 60, 70% probability of a 50 basis point cut in September. And then once they've cut by 50, the odds are that the market looks for more 50s. And then it tails off. It just what markets tend to do. We could go for minus 25 here and recalculate, but the result is more or less the same. What it tells you is that you want to buy the short end of the curve and really not do very much at the long end, because the long end is already pricing that kind of thing. So if we go back, we can see that the difference in something like M25 is really only 20 basis points. But where the meat of the move is going to be in Z4, which goes up at least 30. And that is where you will find that the meat of the move is, in sort of Z4 out to H25. That is what you are looking for. And those are the contracts that will make new highs. Everything else, who knows? The market at the moment is already priced for very good numbers. And therefore, I think that if we just turn this back to 25s, you will see that really it doesn't make all that much difference to the Z4s, but it will make a lot of difference to the Z5s. So what we are arguing about is not if we have cuts, but are they 25s or are they 50s? And the number of cuts basically later in 2025. I think that this, for the information that we have, is perfectly adequate, i.e. 3 cuts of 25 in 2024, and then either 4 or 5 cuts of 25 basis points again for 2025. And you can see how rich we are. We should be trading from 58 down to 03. So we are over 50 basis points rich in M5 out. And that is the big danger. If we assign probabilities that, given the fact that all the numbers that we've seen since the last NFP are in line or even slightly better than market expectations, then it's unreasonable to expect that we are going to have another outlier number. Let's put that into probabilities. If the probability that an inline number is 50% and the probability that a higher number, because what we've seen so far suggests an inline to higher number, is 30%, that means there's an 80% probability that the number is inline or hot, and only a 20% probability that the number is below there, i.e. 125 or lower. If those are the probabilities, that tells me that an inline number is a hot number. Okay, so in anything inline, the sofas have to give up ground. So let's have a look at Z5. If the probabilities are 80% of inline and or hot, then this is a sell, because it will come down and meet the Fed date somewhere around here. We will spike below these lows, stop everyone out, and this is the bar of the Fed, and I think we come back down to it. We are basically looking for something like 40 lower or not a lot higher, because the probabilities say that this you should go into this number short. You should go into this number short, and basically long the longer end, because those to me are the odds. Either you buy the very short end, i.e. Z4, and you short Z5, or you short Z5 and you buy Z6. Something like that should be the probability outcome. I am pretty convinced that there are a lot of stops around here, and a lot of people will also want to buy it here because of the moving average. So this is going to me to be the battleground, somewhere between 60 and 65, on 68. There will be stops. The market will look to trigger these stops, but I would definitely actually be a buyer around the 50 area, because I think that the market will not stay here for the Fed. It would likely try to meet the Fed at that kind of level, because the probabilities that the Fed does something or says something very dovish are not zero, and therefore this kind of level to me is too low. Where we are now is too high, but this kind of level going into the Fed to me is the highest probability. What does it all mean for bonds? Well, for 2 years, I think it means you retest 404, probably take these stops, come to 415, and that's about as far as you go. And there will be a ton of buyers there. Fives, I think, can move even more. I think they can probably come to 387, 390. And the 30-year is the one that's going to move the least. I can't see it much above 425. So a slight flattening of the yield curve, and that's about all you're going to get. I don't think that the yield curve can possibly steepen on an inline to higher number. It's done enough for the time being, and if we have a look at the 2s, 10s, you know, they are on, you know, it's very unlikely that we meet the Fed at these kind of levels. I'd much prefer to be slightly higher than this, around 11 basis points to 16 basis points. This to me at the moment makes no sense. Once again, the probability of an inline to higher number is much greater than the probability of a lower number, which confirms the previous low number. The only low number we've had for, let's say, 2 months is that NFP. That is the outlier, not the other numbers. And therefore, it just seems unlikely to me that we can make new lows in the curve, in the, you know, and disinvert while we have the uncertainty of NFP and then the uncertainty of the dot plots. It would make much more sense to me that the curve flattens again before it goes, because we really need a slew of numbers which are weak and confirm each other to start believing that the Fed should and can cut in 50s. To me at the moment that makes no sense. Yes, the economy is slowing, but it's slowing to a sustainable pace. It's not slowing into a recession. There's a big difference between GDP being stable at 2.5 to 2.7% real GDP and it going negative. I just don't understand why the market is so worried, because every piece of data that comes out or has come out since the last NFP basically saying that all the economy has done is slow down from an unsustainable pace to a sustainable pace and is steady and firm at that pace. So I really don't understand why the market or the bond market is as worried as it is. I just wanted you to have my thinking about equities and their relationship to bonds at the moment. You'll remember that a few weeks back I said it's time for this spread to basically stabilize and wait. And we had this and that, but really, in essence, what it's done is stabilized and is waiting. Now, on Friday, we had in the last 20 minutes with that stupid move, which is much more evident in SPY TLT, but that is why I prefer to look at ITOT over government, because it's less extreme and it's more reasonable. I think if the number is in line to hot, i.e. 165 upwards, we try and fill all these gaps up to this 540 level. If the number is gold, we will go and fill this gap, for sure, this down to 510. So you have basically how I'm thinking about it, and I'll now show you what I think the equities by themselves will do. That is easiest done actually on my clean chart here, which we can enlarge and talk sensibly about levels. On a inline to good number, i.e. higher employment, I think we spike the highs. I think we spike the highs by at least 1 or 2%. So we go to somewhere around here, 57.50, 57.60, but we don't go too far. That would mean that on a number which is weak and where the Fed is projected to cut by 50s, the market to me takes fright. People will start switching in big time to bonds, and levels won't really mean very much, because when people start buying the 2 years or 3 years, they don't really care if they're paying 391 or 390 or 389. It's a bit of a panic. I think we definitely would eventually break these levels, and that is the 55, 60, and we'll go to fill this gap at the very least almost in a day. So I'm looking for this 54.47 area to trade probably on that NFP number. So it would be very bearish for equities, because there's a confirmation that things are not right, and the Fed needs to do 50s, and when the Fed does 50s, then the equity market tends to panic. To me, that makes no sense. Okay, I think the odds of that are low. To me, the odds are much higher than that we break these levels and spike up and then come back. Why come back? Because the multiplier will be in question. The valuation is made of two essential components: earnings and multiplier. The multiplier, because the bonds will be backing up a little but not a lot, will mean basically that the multiplier is a headwind to equities. On the other hand, it's a confirmation that the economy, no way is it going into any kind of recession. It's nice and firm at 2.5%, and therefore earnings should be good. The only problem is that we're already discounting earnings rising in double figures, and therefore I don't think that the market can really spike up and keep on going. I think the market can spike up and then come back and then go up and basically wedge into the Fed. I think it would meet the Fed probably somewhere above these levels, above the all-time highs, but not very far away. And that would be my bet. So if you take it back to that chart of ITOT over government or SPY over TLT, you meet the Fed somewhere around the highs, but not much higher than the highs. The other reason why I don't think that the stock market can keep on powering ahead is QQQ over TLT. It's very noticeable that the tech sector has lost leadership, and therefore QQQ TLT is unlikely to make new highs. I think we are much more likely to remain at this kind of level, around the 5 to 510 area in QQQ TLT, if the numbers are good, i.e. in line to higher. And that tells me that the SPY or SPX, yes, it can make new highs, but it's just not going to power ahead. So these are my thoughts for NFP. Naturally, if I think that the odds are changing, I'll tweet straight away. But I just wanted you to have this short video so you understand how I'm thinking about the odds of what is going to happen next Friday. And please have a great Labor Day weekend, and I'll tweet you on Tuesday.